because the stock market, according to Selfwealth, my portfolio is up 0.08% today. So I was just celebrating. But seriously, I'm just late, so apologies for that. We'll be joined tonight by Blair Hannon from Global X ETFs. You probably know him. You've probably seen him on podcasts, or maybe you saw him on stage in an event or something like this. It's our real treat to have Blair with us tonight talking thematic ETFs. But I can see there's plenty of activity in the chat already. Financial Freedom. Hello, everybody. Caroline, Chef Circle, JJ is looking forward to hearing from Blair. That's wonderful. We'll have time for some questions. I've got a few that I've sent to Blair already in advance. I'll get those across to him. And then we'll give everyone a chance to see what you want to ask him, and we'll go from there. But as always, there's that time of the week where we've got to go through the fun stuff. It's definitely not my joke. It will be the disclaimer, which will come up in just a second. But here's my joke for this week. I was trolling Twitter earlier on trying to find some jokes, and here's the best that I could come up with. A colorblind friend insists that all apples are yellow. I told him that was bananas. And that is my joke. It's my punchline for this evening. Pretty well delivered. Maybe I'll give it myself a 6 out of 10. I was trying to think, how can I turn this into an investing joke? And I just had no idea. So I just took it straight off Dad Says Jokes. Great follow on Twitter. It seems like whenever you Google investing jokes or finance jokes, they always take a turn to the dark side. And I honestly, it's kind of like weeding through everything there to find one that's appropriate for Selfwealth Live. This is the part that everyone looks forward to every week. I do love getting your messages about the disclaimer section of the show and how wonderful you find it. You can see here that anything that we do talk about tonight, whether it's Blair or myself actually, is limited to general financial information only. We do not give personalized financial advice. I believe, Blair could correct me in a second if I'm mistaken, but I believe Blair was a financial planner before moving into ETF and investment management land. But regardless of that, it's important to understand that even though we may know the answer to some questions or these types of things, we don't know your personal circumstances. That's just something we do not know. So it's really important you get personalized financial advice before you act on the information. You can see here that I'm the founder and the director of Rask Group. It's a standalone company. You can see the logo on my shirt here. We're a corporate authorized representative, and there's a number 1280930 of Waddle Partners AFSL 383169. You can read more about what we do and how we do it in our financial services guide. And finally, the views expressed in this live stream are solely those of me and or our guests and do not necessarily reflect the views or opinions of Selfwealth. So you guys will know that we're coming towards the finish line of our ETF mini series where we're building an all-weather portfolio from scratch. Next week, we could go one of two ways. We could have another guest on the show next week, or we will be building an ETF portfolio literally from scratch where we combine all of the views and all of the insights from the guests thus far on the series to put together a real life but fake portfolio where you can see how things would be implemented in different scenarios. So with that said, it is my absolute pleasure to welcome our guest for tonight. There's none other than Blair Hannon joining us from Sydney. Blair, how you going, mate?
Owen, always a pleasure.
Always a pleasure.
I do miss you sometimes. We live in different cities, obviously. So, but fast becoming the best of friends, aren't we?
Yes, we are. We do this a lot, which is great. It's actually a total coincidence, but the podcast that you and I recorded when I was in Sydney last time actually went live on our investors podcast today. So people may be driving home hearing Blair while also sitting and eating dinner, watching Blair right now. Hopefully they're watching the YouTube and not watching while they're driving. That'd be my preference. But mate, it's always a pleasure to have you with me. And tonight we're talking about thematic ETFs and their role in a portfolio, because we've spent a bit of time talking about the core of a portfolio and where the different kind of asset classes sit. We talked about risk profiles, and we talked about the behavioral elements behavioral finance elements of personal finance and investing, and how those can kind of send us off track pretty easily. But thematics are one of those things that are exciting to talk about, Blair. And I like talking about them because they kind of get me really excited about, what the future could hold, about growth and all these types of things, even maybe income and those types of things. And I do have a little headshot of you here, as well as the Global X logo. But to make things really simple and to get everyone on the same page, Blair, can you just fill us in, for those that haven't come across thematic ETFs, Can you just describe what they are and how they work?
Well, I think this is it's a bigger picture. The thematic ETFs, I think for us, and this is the general rule, and I'm sure many of you or the guys on this call tonight would know this whole mentality that when you want to invest in any type of investment, you want it to be long term. You want it to be, thinking about how, whether it's the bottom drawer or whether you're moving it around, but and you would have talked about that in the core concept probably previously as well. Thematics are exactly the same. So what you don't want, though, and this is obviously you don't want a fad. So when you think about thematic ETFs, and I think to the question of how they potentially differ to core, the wrapper's the same. So the ETF's the same. So what you're getting as a type of investment is the same. It's under the hood that changes. Okay. In that what you're buying, and look, I'm speaking out of bias here, mate. Obviously I'm an ETF guy. I work for an ETF company, but for thematics, ETFs are by far the best tool to use to encapsulate what you think the thematic is, because it can be either broad, it can be narrow, it can be specific. It has obviously different costs. You get different diversification. So to really explain what they are, the differences are, essentially what you're getting for a thematic is, if you think about a broad index, S&P ASX 200, S&P 500 in the US, NASDAQ, Dow Jones, generally, I won't talk about Dow Jones, but generally what you're getting is either a country index. So S&P 500 is essentially the US version of the top 500 companies in the US. ASX 200 is the same thing for Australia, FTSE for the UK. So what you're essentially getting for those type of exposures is a market cap weighted. So the biggest companies at the top have the biggest output from a performance point of view. And then that encapsulates, in a sense, the geographic exposure of what you're trying to buy. And then you obviously, how you plug all those together is how you build a portfolio. You can obviously have bonds in part of that. We're just talking about equities here as a top level. Thematics, though, are vastly different. Is you're trying to think about how you're playing a much bigger long-term trend. So you wouldn't say, I'm buying Australia through the ASX 200, which is a long-term trend. That doesn't equate. What you're buying Australia for is because you understand the companies in Australia. You probably know who they are quite well. You're building that as your core for your performance of your overall portfolio. Thematics are much more around thinking, and I'm sure you've talked about this previously, but this whole core, what's the other part of the core? Satellite, usually sit in the satellite components. They're never going to be your biggest chunk of your portfolio. In that they provide a sort of an avenue or a way to play, essentially an idea, like a generalized idea that you think is going to happen in the future. And this is why I meant to mention before, I just want to label this point a little bit, that ETFs are the best tool, because out of those ideas, the ETF is going to encapsulate the idea in a much better way than buying, say, a single company. So if you were to buy, you're buying just Tesla, for example, because you like electric vehicles, and we can talk about this later if you want. What you're getting is Tesla. What you're getting is a bit of Elon Musk in there. What you're getting is, how they're working with the US versus China versus Europe. So you're getting a lot of that. It's a what we call in our world idiosyncratic risk. Essentially, that's a long word for just saying you're getting that single stock risk, which can be really good, but it comes with risk. When you're getting an ETF, you're getting usually what you're getting at the thematic level is the whole encapsulation of what you're trying to achieve, whether that's electric vehicles, whether that's some decarbonization, whatever technology, types of technology, whatever it is, you can encapsulate that in the idea. So you're getting instant diversification from an ETF. You're getting exposure to multiple companies playing that type of thematic instead of being in one single stock. So does that wrap it up well? Is that
Yeah. I'm sure we'll have questions that have come through. There was one question, and I don't know if it was directed to me, but Paul said, is there merchandise available? Yeah, totally change the topic, Blair, but you might remember last time we had Global X on the show, I can't remember if it was you or Kanish had a pretty cool jacket from Global X, so maybe that's where that question comes from. But back on the topic. So basically what you're saying, if I'm not mistaken, is that if you're looking for like a broad exposure, just like you want to just keep it in your bottom drawer, that's what we typically think about as a core ETF or a typical ETF. And then anything that's kind of more pointed and purely focused on an idea, say like decarbonization is the thing that we spoke about recently. But within that, there might be, as an overall idea, there might be multiple ideas. And the key difference when we think about this is that if you were just to buy Tesla, you're going to get whatever outcome happens specifically for Tesla. So that might be regulation, it might be whatever. But if you buy an ETF, I can't remember off the top of my head if Tesla is included in the AC/DC ETF by Global X.
It is, yeah.
Yeah, it is.
Yeah.
So that one would have a stack of different companies across multiple, geographies, countries, etc.
Look, it's bang on. So, and that goes back to that point. Like, what are you trying to invest for? That's the core question of what you're trying to do. So, to your point, I used to be an investment advisor building portfolios, and part of that whole concept is what's your initial strategy? What are you trying to invest for? What's your outcomes? Are you trying to invest? That you're trying to build for, whether that's long-term investing and that's saving for young kids, saving for your kids, whatever it is, doesn't matter. You'll know that yourself, not about for me. So when you think about how you build a portfolio, what you might like to do is you might like to really know and understand Tesla as best you possibly can. Think, hey, great, I believe I've got a bit of an edge here. I can invest in this. I'm going to get better outcomes. For many people, and what we've seen, certainly in Australia with thematics and definitely in the US, is they get the theme really well. So they understand the theme, they grasp the theme, they believe in the theme, and then being able to buy that theme through an ETF is much simpler than having to go down to the nuance of understanding the P&L and the balance sheet of Tesla. In my opinion, this is my opinion, and all the nuance that is involved in a certain company. That doesn't say you're not going to be right or wrong when you buy a certain company, but it just takes a lot more work than if you still believe in the theme. You're more likely to be right, based on some of the more high level investment thesis than having to do the nitty gritty at the P&L level. So I think, and that's that point. I think it's an idea. So electric vehicles, we use that as an example again. There's multiple parts of the overall supply chain that play into electric vehicles. It's not just Tesla. There's obviously lithium at this end. There's at the far end. There's obviously EV manufacturers. There's also regional manufacturers. There's a whole bunch of battery technology that's getting built. So that's just one example, right? Of, hey, this is a bigger picture concept of what this theme is. And that's what you want when you're investing in thematic. I mentioned this really early on. Like, what you don't want is a fad where it's going to come and go. And I'm not going to say this is necessarily a fad, but potentially, like, I'll look at metaverse, for example. It hasn't really taken off yet. Not to say it's not going to take off, but in the short term, it's harder to see if that's going to be a long-term theme. And that's where you got to weigh up your risks and process around what you want to buy and how long you want to hold it for.
Owen's actually asked a question about hot topics and fads and that sort of stuff, which we'll get to in just a minute. But one of the things that we talk about a bit, Blair, is the idea of having a core and a satellite. If you're a financial planner, you would say SAA instead of core, and then you'd probably say something like TAA or something else for satellite, but it's basically the same thing with some minor exceptions. Would you say, like, if someone's watching this and they're a beginner, when it comes to ETFs, like where should they start, do you think?
Oh, look, putting my old hat on, core's going to probably drive a larger amount of your total performance, because it's going to be likely be a larger amount of your portfolio.
Yeah.
So to your point around with the acronyms, and I'm sure you've worded up all our friends on this call, but what your strategic asset allocation looks like. So how does your allocation to Australia versus in combination with the US to global to then to have some bonds in there is likely to provide the bulk of the outcomes that you want to achieve. To your point earlier, though, on the exciting part is, thinking about, well, what can I do outside of that to invest in things that I really believe in, that I've started to see on the, at the nascent edges of technology. And I think that's going to be a really big opportunity in 10 years' time. So I can invest in that. So that's where thematics will come in. And to the point earlier, again, that's where the satellites solve some of those problems. So core's generally boring.
Yeah.
Boring is good. Boring is what you want. It sits there and doesn't, and we won't talk about the rebalancing, all that process necessarily, but it's good. Where thematics is generally exciting and going to be more volatile, it's going to move around a bit more. That doesn't mean it's going to solve, again, massive portfolio outcomes for you. That's what the core is meant to do. That's where the work's meant to be done.
Yeah.
So it's what we typically see, satellite, between 2 to 5% allocations, and whether it's a certain ETF or a stock or whatever, managed fund, whatever way you want to play it, because the core is going to do the bulk of the work for you.
Yeah. Yeah. And that's, it seems to be the way the industry is going as a whole, like away from individual stocks and as ways to express a view towards more thematic focused ETFs and others like specialized ETFs that focus on a particular thing for I guess an expression of a trade is how I'd frame it. There was the question that came through from Owen, which is one that I've had to put up with a lot of times as well. So I thought I'd put it to you this time around, Blair, which is that some academic studies show that when an ETF is launched, in particular, like a thematic ETF that focus on, say, like gaming or I don't know, insert crypto, like some trend or whatever, that for the first few years after that, they tend to underperform a little bit. So I'm just curious how you think about that. And I guess if you have any pros or cons around that way of thinking.
Yeah, look, I haven't read the studies, and I actually probably don't doubt it. I think, and it depends on how you think about what the particular thematic is. I think it's going to be very specific. And I think the interesting part on what you said in that sentence, though, is the first couple of years. Well, the point of these thematics is, and when we think about what we're trying to do with thematics, they really have to be long-term. The intention isn't to make your money and get out. And when we think about the concept of necessarily, how you want to invest, we've got this idea of basically technological adoption. We use this thing called the S-curve as a way to do it. Maybe we can bring that up later. But the idea here is that know where the thematic is on this S-curve, in terms of know where the thematic is on the levels of adoption. Levels of adoption across its, in terms of across its technology. So if you look at this chart, it's not, maybe we can make it slightly bigger. But the idea here is to say, well, if I am investing in the metaverse, and we'll use that example because I just brought it up, it's very early days. It's a nascent technology that is certainly not up anywhere near the curve of the mass market or the technology. And I think I've talked about this on this with Selfwealth before. But the early majority is where the growth is captured. So if you look at metaverse, you'll see it's on the far left, the second one from the left. And what you're going to get, the further left you go, you're going to get more volatility. You're going to get more companies in that theme that might actually go under. You'll get some big winners. So you'll get some big winners that work out of that, but you don't know which ones they are. AI is another example of this at the moment. You're going to get some big winners, but you don't know which ones they are. It's very hard. So when you think about this theme, what you're going to get is you're going to get a risk and return profile that is higher. So more potential return with much higher risk than if you were to go to the right and pick up, say, something that's been around for a while. And you mentioned video games then as an example, Owen. Look, esports is certainly probably newer, but video games have been around. I remember when I had a Nintendo when I was a kid. I'm 40 years old, so it's not like it's a new technology. So it's incrementally getting better, and so you're not going to make those hugely potentially excessive gains because the growth has somewhat been had in comparison to something like the metaverse. So look, how do you delineate which one's a fad and which one's not? You don't know until after the fact. That's the point, and that's the thing for all investing. Everything is you don't know until after the fact. And hindsight's, the hindsight exchange is my favorite exchange you can invest on. So it's one of those things where, we use this framework as this S-curve framework as an idea to say, hey, look at what choices you have, understand what you think is going to be representative and good part of your portfolio, but also going to have longevity, and then start to think about how you're going to allocate to those types of themes.
There's actually a question that is probably worth planting now, Blair, which is from Harry, who asks, I've often heard that thematics are created at the peak of people's excitement, which is kind of what we just talked about. But they often won't be relevant in 10 years. How long do they tend to stay listed? So I guess the second part of the question is actually the question is like, how long do ETFs tend to stay listed maybe not even ETFs, but how long until you know whether it's working out or not, I guess?
Well, the good thing about ETFs is you can look at the performance at all times. And I think that is a common thing we hear as well. Like, you bring out a new thematic, it's going to be at the top of the market because that's why everyone's interested. And I know we talked about this before. I think you had it on screen. because we bought out recently an ETF that's based on copper. Now, copper's not really a thematic. It's part of our decarbonisation idea of moving towards, a decarbonisation future, moving towards renewable infrastructure, etc. Everything is built around that. Copper's an example of that, in that we bought this copper ETF out, wire, down today. That's okay though. But this fund in particular, what we've done is we've invested into one of our US funds that's been around for nearly 10 years. So it's not like, we bought it out to Australia, but this is an existing fund that's been around for a long time. So I think you just got to also, again, I use this terminology, go under the hood a little bit and understand what you're investing in. So you look at, I think this is the US version. You got on here. Yeah, so you can see that, over 5 years, it's obviously done quite well. You look at the current situation with copper. We won't go into the nitty gritty here. I think we talked about it on the podcast, if I recall.
Yeah, we did.
But the idea here is, in this case, and I'm just using this as an example, you've got copper that we bought out because we saw the demand in the US and we saw the need for it to represent in Australia. We got really lucky. We actually released it on the same day that BHP took over Oz Minerals. So we'll take that. No skill on my own. But so yes, I think you need to have a good look at these thematics and think about, and this is why it's probably more important, a little bit more important than when you're talking to the core of the portfolio, but going under the hood. And we can go about this in a moment as well, because I know you had some questions about this, and understanding. And this is it's a bit of detail here, but it's worth it. The methodology of the actual ETF, because most passive ETFs, or actually all passive ETFs, track an index. Obviously, we know the advent of active ETFs has come along, where they won't do that. But all passive ETFs track an index, and that index is available to look at and say, what is it? What are they doing? Like how are they building this portfolio? And we know ETFs are great because you know what's in the portfolio, but how are they building this portfolio? When will it rebalance? What's going to come in, come out? These sorts of things might be helpful for you to say, this is my expectation of what I'm buying. Is it going to meet the outcome that I'm trying to get? Because if it doesn't, and we can use we hear the example a lot on ACDC. ACDC is, I mentioned it earlier, the full supply chain. It's not just lithium. So if you're thinking you're investing in it and it's just lithium, it's not going to, your expectations and outcome aren't going to be the same. They're going to be out of whack. So it's really going in and having a good look at that. And look, it doesn't take hours. It could take you 10 minutes, but just going, okay, that makes sense. That's kind of what I'm after. Or it's not what I'm after. I'll go do something else.
Yeah, it's kind of like just a kind of step back and common sense approach and just look at it from the perspective of, well, what am I actually getting? Which is actually a good point. I actually did want to just ask you a few questions around how you think about picking a thematic ETF. Like if you were in the shoes of an investor, how would you spot one? And then I guess not just that, like how does the way that the ETF is constructed change the outcome? So there's like two questions in one almost, but like if I could just boil it down, it's like there's the what it invests in, but then it's like the how and how much. Like I think there are good examples in Australia of ETFs that just do equally weighted. Like if there's 100 stocks, you put 1% in each, versus others that might say have a different approach where it's like you said, the biggest ones like market cap weighted get the most share of the portfolio, if that makes sense. And I think you did you send me a table for this?
Yeah, look, let me talk to the ideas around thematics and how you can think about it. Then we'll put the table up and I'll explain it to you. So thematics are, again, they're going to be different than your core and the concept of core, because generally most core, not all, but most core ETFs, in particular passive indexes, are going to be market cap weighted. So you know that the biggest companies at the top, and then because they're the biggest company at the top, they're going to drive most of your returns. So it's not basic, but it's pretty simple. Actually, the nuance around that is even, and you might not know this, but the SP 500, for example, is certainly market cap, but does have a selection committee. So to get selected, and Tesla, I don't know why we bring up Tesla all the time here. It took a long time to get admitted because that selection committee didn't want it in there. I'm actually not sure the nuance of the reason, but anyway, that's essentially the program for that one. So it's not purely market cap, but it's essentially the biggest index we've got globally. When we come about thematics, though, so go off core, I think there's the way that we think about if we're going to bring it out, and that sort of stacks up to the way that you should think about if you're going to invest. The first one, without any question, and this is probably going to have a bigger weighting than everything else, is how much conviction do you have that, and we talked about this earlier with questions from Owen, another one, how much conviction do you have that this is a proper theme. So a true paradigm shift in how we're thinking, whether that's demographically, whether that's politically, whether that's technologically, whatever it is. Like, is it going to be a big, massive shift? And it's easy to look historically and find those. It's much harder to do it in the present day and look for the future. But think about like mobile phones and internet and PCs, like these big technological shifts that are happening. Like, you could probably say EV, we're kind of in the middle of it. And on that S curve we had before, where we see it as kind of before the mass market kicks off, because we know, it's only really taking off as we speak. So, like, how much conviction do you have? And the second 2 points sort of combine but work out. Is that theme, and this is probably more important for us, but it's important for you as well to think about, is it investable? And then from your perspective, how do you want to invest in it? So is it investable? Are we as an ETF provider going to be able to bundle up enough companies that truly encapsulate this theme, not just broad? Like, if you want to go and buy AI, and we put an AI ETF out there, and all it is Microsoft and Google and NVIDIA and AMD. Well, that's like, they're going to have revenues and drivers that are much different than just AI. So that's not going to encapsulate AI. Now, that might change in a couple of years' time, but that's the point. So is it truly investable that it's going to get your expectations to your outcomes? So then, knowing that, and from your perspective as an investor, it's around, well, how do I want to do it? So we mentioned before, do you want to do it via a stock? Do you want to do it via an ETF? Do you want to then use an active manager to say, hey, I really like Chinese technology, for example. Maybe an active manager is better in that space. Whatever's up, that's up to you. Whatever's the best way that you think is the best way to do it. But as long as you then have, as long as you're highly convicted in it, you know that it's investable and how you're going to invest. And then the third part for us is like, how do we really see this as a true long-term or even evergreen trend? If that's the case, then we'll tick that box and we'll bring out an ETF for it. And it should be the same. Like, if it ticks those 3 boxes for you as an investor, then you can think about, okay, how do I invest it? And that a different story is how much do you allocate in a portfolio, but that's kind of getting you most of the way.
Well, that's really good, Blair. We'll actually be talking about that next week, about like how to allocate in portfolios and that sort of stuff. But there was something else that I wanted to ask you, which is just how you think about comparing ETFs. And you were kind enough to send across this table that you prepared, because one thing that people are concerned about, and I've got another slide on this in just a second, is like the overlap of ETFs in their portfolios. This is another question that I get a lot when people are building portfolios. They might end up with 2 or 3 ETFs that do something very similar. And while that might not be the biggest issue, although maybe I'd say that's a few too many, they may not just know about it. And that's where they're making the mistake, in just not knowing and being aware of what they're actually investing in. So you've come with like a comparison table here and how you think about it. So can you just step us through this briefly?
Yeah, so I want to make a really clear point here. I've just picked 2 that, because we talked about these 2, there's nothing good or bad about either of these ones, whether it's the Global X one or the BetaShares one. They're both going to provide you with an outcome. So there's not one. I'm really making it really clear. One's not better than the other one. Yep. That's not what I'm trying to give you an outcome for here. I just know a little bit about our one, and I know BetaShares have got something of a similar nature. So this is an easier way to compare. That was my only point here. So nothing against BetaShares. I think they do a great job in the Australian market. Got a lot of friends there. I think the point here that I wanted to make is for investors is to know what you're investing in and the differences that you get when you're investing in something. We talk about overlap in a moment. But the point here is a little bit is that, say, ACDCC, for example, is around, again, the whole value chain. So around, so when they say electrochemical storage, essentially storage for future use in terms of future energies. And then you've got mining companies around battery grade lithium. So what this actually encapsulates is multiples, where it gets, start of the supply chain, which is lithium, middle of the supply chain, which is battery technology, and then vehicle manufacturers that are also working in the world of battery technology, the whole thing. Whereas the Sol Active version, and both Sol Active indexes actually, the BetaShares version is slightly different, where it's probably more focused on the electric vehicle side of things. Again, neither of these are wrong, but you might believe in the more the electric vehicle side than the lithium side, which has had a bit of trouble lately. So that's just the high level. Then you go down to the next level, which is, how do these work? So you've got ACDC, which is what we call a modified equal weight. So essentially it's equal weight with some caps in it. And the same thing for the BetaShares version. They've got a market cap version, again, with some caps in it. And they use sort of a pure play versus non-pure play to set those caps. ACDC has got an ESG screen, a high-level ESG screen. Again, these are the nuances that you just need to work out to give you what's going to work. And then same thing, you can look at the sectors. There's the heavy weighting in consumer discretionary, as you would expect. That's where automobile manufacturers sit. So again, heavily focused on both, but probably a little bit more in materials on the ACDC side than you would get in the DRIV one, and quite a bit different in the geography. And then I think going to this point, and actually I didn't even want, the only reason I put performance in there, Owen, it's just because it makes it like that's what people compare on, but I want people to not look at that as the number one outcome, because we all know that anything in the past doesn't mean it's going to happen in the future. You need to think about what's happening next, or not what just happened.
For sure.
But what I think was interesting was, and this is the interesting part around overlap, and I think what overlap does, it causes unintended consequences in a portfolio of essentially doubling down when you don't really mean to double down in certain areas. So look, I would be generally surprised if someone bought both of these ETFs because they're encapsulating a similar type of theme. They're giving different outcomes, but they're encapsulating a similar type of theme. But in the case of the overlap, in particular for this one, in the top 10s, this has just happened to be in the top 10s, we had BYD in both in the top 10, and then the rest of them, there was a spattering across the other holdings. So the interesting part of this is you are going to get different performance outcomes. You are going to get that. And it's going to depend on, I just picked year to date 1 year. Like if you pick different timeframes, there's a really good chance that DRIV outperformed ACDC. Right? Like it just depends. The timeframes are really easily to manipulate. So it just depends. At the moment, we've had really good runs from the consumer discretionary sides. The car manufacturers have been great. Well, you might have had great rate of lithium previously. Like this, it's not a perfect answer. But the point is that if you looked at those two ETFs, I would hope that most investors would go, well, I don't need both. I'm going to pick one because I like one or the other. Where you get unintended consequences might be if you've got a portfolio, and we talked about copper before, and you've got BHP, Rio, you had Oz Minerals, you had Sandfire. So these are all the ones. And then you go and buy a copper ETF. Well, what are you doing that for? Because then you're going to get pretty heavy overlap by encapsulating both those sort of ideas in one spot. I think, and maybe Owen, you know this, I don't know, but the problem sometimes is being able to do that calculation is not easy. Like software to break all your ETFs down into individual stocks and weight them back up, like you need to be pretty good at Excel for that. So there's no real easy solution to do that. So it kind of comes at the top level to understand if what you're doing. So if you go and buy ASX 200 ETF and then you go buy an ETF that's focused Australian miners, well, again, what are you going to expect you're going to get? You're going to get pretty heavy overlap. So you kind of need to figure out the top level, and then if you think that's going to happen, start breaking it down and looking a bit deeper.
There's one question that's come through from DDDD2319. That's the YouTube handle. And if you have got some questions, we've got Blair for a couple more minutes, fortunately. But the question was, and I think you answered this before when you talked about the S-curve, are the thematic ETFs everlasting, or do they eventually reach a point, kind of where they hit maturity?
Look, I think if you go back to the S-curve, and one of the examples I use a lot, is the one on the far right of that S-curve. You don't have to bring it up, doesn't matter, but
okay.
is social media, as an example. Now, is that over? I wouldn't say it's over. Is it evergreen? They're going to be around for a long time. Some of those companies are good companies, and they're going to have, that you've seen some like TikTok come along and reinvigorate that market. But then you look at these S-curve again and you say, okay, well, what in particular is Facebook trying to do? So Meta, they're essentially an ex-growth company. They're very great free cash flow, low debt. Like I'm not saying a good bad company, but they're kind of an ex-growth company in terms of where they're going to get more users from. And they're going, okay, well, how do I improve that growth potential? And they move all the way back to the far left on that S-curve and go and try to do the metaverse. So they're trying to encapsulate growth in different ways, and that's what some of these companies can do. So, if you thought that an internet ETF didn't exist, but back in 1990, it probably has run its race now in 2020. But the good thing about ETFs is they consistently rebalance. New companies consistently come into them. So what might happen is if there's an amazing new battery manufacturer that comes along that is pushing the limits of, they're moving out of lithium battery now, they're moving to sodium or whatever it might be, right? That has the capacity to then come into an ETF and you get growth out of that. So that's the ability where what you might find with some of these thematic ETFs is the general idea is starting to roll off, but some of these companies start to roll in that are new and exciting companies and grow as part of that portfolio. If there's market cap or even it's equal weight, they're going to have a bigger weighting initially. And that might then provide you some more growth. So there's no perfect answer to that question. You would hope that most of them are a version of evergreen, but look, some of them have likely run their race. But again, ETFs haven't been around long enough that, thematics have really only been around for sort of 7 or 8 years. So at this point, most of them have got a fair way to go.
Yeah, and I guess most ETF providers wouldn't be launching a thematic ETF with the view to having it just for a few years. Obviously, they want it to grow. So just so we're all aware, an ETF provider wants the value of the ETF to go up because it means there's more assets inside it, which is more fees. So they want it to be around. They want it to grow over the very long term. So we've also got to understand incentives, as Charlie Munger would remind us. Well, Blair, I know you've got to get off to dinner, mate, but I do really appreciate you staying back extra late in the office and joining us yet again for Selfwealth Live on this mini series in ETFs. So really appreciate it, mate. It's always a pleasure. People can head to globalxetfs.com.au. There will be a link in the description for people to click on and find out more. We really appreciate you spending the time here tonight with us, mate.
Thank you, Owen. Thank you. And great questions as always. Look forward to being back next time.
Great. Thanks, mate. Cheers. Have a good night. Well, that was Blair Hannon from Global X ETFs, head of investment strategy here in Australia. So thank you, Blair, for joining us tonight on behalf of everyone. I can see some questions have come in. I do have quite a few topics and things I want to get to as we continue through the ETF mini series. Obviously, thematics make up a huge part of at least people's focus, if not their portfolio. And I saw a few questions come through. One was from, I think it was Anne, and I'm going to actually, it wasn't actually a comment, Anne, but you made a comment saying I've been tossing up between ACDC and PLS, which is the stock, Pilbara Minerals, or Pilbara, I can't remember, and has a better, PLS has been a better performer. So I want to actually quickly show something to you. I'm going to bring up my screen and actually show you a bit of how I used to do Microsoft Paint and show you how these things actually work. It touches on a lot of what Blair was just mentioning. I'm just going to zoom out again and zoom back in again. If I can bring up my screen correctly, let's go something like this. Okay, so when we think about ETFs and we think about the outcomes of said ETFs, so typically what happens, I'm just going to draw a chart for you, like, not like that, like this. This is my Microsoft Paint coming out, ladies and gentlemen. So you're very welcome to this masterclass. But typically what happens is some companies in the industry will perform well over time and some will perform not so well. So typically what happens, we can plot the outcomes of companies over time. So if we just take a really good performer, we take like the best performer. Oh, don't know what that bit was. Let's say it looks like this. Let's say the next best performer looks something like this. Oops, I keep on getting to this point and then I stuff it up. So I'll go again, give myself more room here on my desk. So the next best performer might look like that. The next best performer, if I go here, might look something like this. And you can kind of plot that over time. And typically what ends up happening is you end up with a bunch of different performers over time. Now, what happens is there tends to be, based on what we know from academic theory, is there tends to be only around 4% of companies, 5% of companies. So 4% of companies account for all of the wealth from stocks, right? So typically what happens is that of all the companies on the stock market, once, this is just a study based on University of Arizona professor Bessenbinder. And so basically people think that what they're picking, because they've got the idea, right? Confirmation bias, which we talked about last week. Everyone thinks they're picking this one. But the reality is probably 9 out of 10, maybe even more, are not this one. And so what diversification does, if I could just highlight it very simply, what actually the role of diversification is in a portfolio. I'll see if I can do this in a very simple way. So the role of diversification is effectively to go like this, and watch this Microsoft Paint. You're going to love it. Something like this. The role of diversification is to narrow the outcomes of a portfolio. So you actually end up capturing this. So instead of trying to pick individual company winners, what you actually get is you get the entire portfolio. So you never get better than the best, but you never get worse than the worst. And so an ETF, to Blair's point about why you use ETFs for some thematics, is that you get this. You get this outcome. You don't get this outcome if the portfolio is constructed correctly. Obviously, not all ETFs are created the same, and there are a few other things, et cetera, et cetera. But this is actually a visual representation of what you get. So this is not just particular to thematics. You also get kind of this outcome that's in the middle of everything. It's the average of all the things. And that's basically how it works. And I just wanted to show you kind of how that all adds up and why you might think that you're getting this. And indeed, you might be. You know, Pilbara may be this one, but Pilbara may also from this point on become this one. Now, you know me, I love picking individual stocks as much as I love picking ETFs, but I just wanted to illustrate that point that maybe, you know, even within the thematic itself, you could have a stock and an ETF just in case you missed it. And then the other point that I wanted to showcase, and Blair did that through an example, and in particular, this line here under the style part, where typically we know the performance of the stock market as a whole, pardon me, is based on those 4% of companies doing really well. And what tends to happen is, unless the ETF can capture those 4%, you might lose. So because you don't have them in the ETF because of some rule or some weighting constraint or something like that, you might not actually get them. But typically what we find, and what I found with thematic ETFs, is the earlier they are in their journey, typically what you find is there are more constraints around how many ETFs, how many stocks are inside the portfolio and how big they can be. Because you simply don't know, the range of outcomes are too broad. You can't necessarily just base it purely off the market capitalization. That is the size. Remember, the market cap, if we go with BHP, is just the value of all of the shares that are available to buy or in the company. So if you had $222.9 billion, you could buy all of BHP shares. That's the market cap. And typically inside an ETF, the biggest companies get the most weighting. But in the earlier days, many ETF providers and index providers control how much an individual company can get, because some companies early in the journey are not necessarily big for the right reasons. Sometimes they've just gone up on the hype, which is what Owen talked about earlier on, where some companies in hydrogen, for example, could be big simply because more investors are buying them, not because it's actually a good company. So that's what I'd mentioned there. Okay, so we've got some questions here. I do have a second part of this show, but it'll only take about 10 minutes. So I'll just answer some questions really quick. Chef Circle said, any thoughts on quality ETFs such as Moat or QLTY? Chef Circle, if I'm not mistaken, QLTY, is that the global ETF? Yes, it is. Okay, so the difference, you would want to compare this one directly with, let's get rid of that, directly with this one, Chef Circle. This is the one that's been around for a longer time and has more money invested in it. Some of the key differences are this one has 300 stocks. I think I've actually got it in a different tab. Yeah, I do. I've got it here open. So this is the Van Eck one that has 300 stocks inside it. And what I wanted to actually show you, there was another slide I didn't get to before, was this slide right here. And I'll zoom in because Blair actually provided his own chart, which was a real treat. But if you think about portfolio overlap, it kind of looks like this. So let's say you want the S&P 500 ETF, which Blair explained before, is the most common index in the world. It's for the US market. It's got 500 companies. Or you want to go with the Global X FANG ETF, which just has about 10 or 11 companies. Or you want to go with the Qual ETF, which has about 300 companies. There you can see there's kind of, they're all different. This one's got like 10, 300, 500. Yet if you go into the portfolios, what you can see, let's just have a look at FANG first of all. FANG has NVIDIA. That's the graphics card company. It's got Google or Alphabet. It's got Apple, Amazon, Microsoft, Meta, Netflix, Snowflake, etc. It's got Tesla down there as well. But now let's go into the big IVV ETF. Here we've got Apple. Here we've got Microsoft. Here we've got Amazon, NVIDIA, Alphabet here again, Meta down here. Basically, like so many of the same companies. Well, let's go across to Qual. Qual, the QUAL ETF, has Microsoft, Apple. It's got NVIDIA. It's got Facebook / Meta. It's got Google / Alphabet. You know, it's got the same companies, right? There's a huge overlap between these three companies. But if you're looking for a thematic, you wouldn't call this one a thematic because you also get all this other stuff, right? You might get all this other stuff. But with this one, you probably could call a thematic because it only has about 10 companies, and you can see they make up a very big part of the portfolio. I don't have the weightings over here, but they're not nearly as big for these companies. So this one is, FANG in this instance is basically buying it's choosing from the same collection of stocks, but it's saying, I want more of those ones. Whereas the Qual ETF is filtering a lot of what's in that, but also global companies, and saying, what are the quality companies within that universe? And this one's saying, this is buy them all. So this is a good illustration of how you get overlap with three ETFs that kind of do three different things. And I wanted just to highlight that for you all there. Bucky, you've just asked, anyone know what to use instead of ticker because it seems like they charge a subscription fee? Yeah, so what you can do, let's have a look at these three ETFs and let's go to here. Fund compare. So this is the free version. I'm sure Vanguard are perfectly fine. This is a free tool. Let's have a quick look about what you get in here. So let's go QUAL. Let's go IVV. This isn't going to be very informative for IVV, by the way. You'll see why in a sec. And let's go with FANG. Okay. So we can see our, zoom out a bit. We can see our three different ETFs. Why don't we chuck QLTY in there too? Because that's what Chef Circle wanted. Okay, so we can see they're all from different ETF providers. And this is, by the way, this is just in the chat now. I'm dropping it in. It's all free. You can see that what they are. You can see where they're exposed to. So these are just USA or North America. But this one is the whole entire world. Same with this one. You see the indices, the costs associated, all quite similar except for S&P 500. And this is quite normal. When an ETF is very vanilla, it will have lower costs. But when it's more thematic focused or style focused, it will have a higher fee. You can see the size of the funds. You can see how many holdings are in them. You can see, the inception date. So when it started, obviously longer is typically better because it means that it's been around and established for a while. I mean, if it's survived 9 or 10 years in the case of Qual, you've got a better history to study it. And you can, if you go down, you can actually see some other things. So you can see performance. If we put that in a table, you can see performance pretty easily. So over 3 years, we can see like the FANG ETF has performed incredibly well over 3 years. And that's because it invests in those giant tech stocks that have done so well. Now, if we go down, that's not really informative because they're just all stock ETFs. But if we keep going down, this is a measure of risk. So this measure is here, higher equals riskier. So you would expect that the FANG plus ETF is riskier. It's got more ups and downs because it's only got 10 or 11 stocks, whereas this one has 500, right? So you'd expect more variability. It's like, if you got 10 people to stand up and you measured their height, there would probably be in one pack of 10, there would be a lot. And then if you got another 10 people to stand up, there'd be a big dispersion, what that average is versus the other average. Whereas if you've got 500 people to stand up at once, the average would be very close to the population average. And that's basically how we think about risk. If we continue down, you can see what the valuation of the companies inside the ETF are. So in the case of FANG, they tend to be more expensive stocks. Not necessarily a bad thing because sometimes expensive stocks can keep growing. They're expensive for a reason. Now, this one here, Chef Circle, is probably something that you will find quite interesting because you were comparing this one to this one. You were comparing the Beta Shares one, which has just come out more recently. It's a tiny bit cheaper from memory than the Van Eck one, which has been around for a long while. Right here, yeah, so it's slightly cheaper. But one of the measures of a quality business is its return on equity, which is this thing right here, yeah? Now, what they say in these thematic ETFs is the thematic ETFs will say we target quality businesses typically. Now, FANG doesn't say quality in the title, but it basically is kind of like that because you're getting a bunch of 11 companies that tend to be big and tend to be profitable. Whereas you get 150 here and you get 300 here. Now you can see, you're about to see the difference in how effective they are at looking at these types of metrics. So if we go down to the return on equity, the Van Eck Quality ETF says it targets quality, so you would expect a high return on equity. Now, the BetaShares one is 32%. Of course, from any 1 year or any 1 month to the next, these numbers will change. But if this was consistent through time, what you would kind of be ascertaining from this or getting from this data is you'd be believing that the quality ETF has a more pure focus on that return on equity statistic or metric, whereas the others don't. And neither of these two have a focus on that, whereas these two explicitly say we target quality companies. So that's kind of the difference. You can, again, have a look at the different holdings, and the holdings here obviously don't work because a lot of what ETF providers do here in Australia, if they've got a parent in the United States or somewhere else, is they just take the money from the Australian ETF and put it in the US ETF, which does the tracking. So this doesn't look accurate. It just looks like there's all money invested in one thing, which there is. It's just another ETF. Sector breakdowns, etc. So I hope this answers some of your questions about how to kind of weigh up the different ETFs. All of this data, by the way, is provided by Morningstar. And if you are a Morningstar paid subscriber, you can actually get more analytics. You can actually dive deeper into it on the Morningstar website. But this is made freely available here, so that's why I bring it up. Now, which is the good bond ETF to invest in now? Well, Lily, that's a good question. I can't tell you specifically, but next week, Lily, I will be answering questions like this. So next week at 6 p.m. on Selfwealth Live, I will be going into depth about bonds, about cash ETFs, about Australian stocks ETFs, about global stock ETFs, about overseas ETFs, all of those different things. When you said, I enjoy looking at the fees over time against portfolio size. They really don't make a huge difference in the mainstream ETFs. Yeah, they really don't. It's more the way the portfolios are constructed. Okay, so I've got my last set of slides I want to get to, and you're going to love me for this because I know how much you love the disclaimers that we get to every week. But this thing's probably just as exciting. Like, this is the type of thing you tell your friends about tomorrow. And that is, we're going to be talking about what happens once you buy ETFs and how to manage it. This doesn't get talked about a lot because people think it's really boring, but it's really important. So a lot of people know how to buy an ETF. You can log into Selfwealth or log into your broker. And I'll just go in here now. You can log in, find the ETF that you want. This is just an example. Obviously, I'm just using this as an example. You can see here that you could then, if you had your account ready to go, you could click buy and so on and so forth. Now, when you click buy on an ETF, like say you buy the FANG Plus ETF, what you'll find is that you get paperwork from someone that you've never heard about if you're new to investing. And the people that, or the organizations that are new to you will be these organizations like Computershare, Link Market Services, Boardroom, and there are a few others. So you're probably thinking, well, what the heck are these things? So let me just explain how this web of companies work. So there's you, the investor. You pick your broker, for example, Selfwealth or whatever broker you use, and you'll place trades, and Selfwealth will, there's actually another organization that sits in here, but never mind that. Selfwealth places your trades through the ASX where the shares are available for sale. And this company is obviously a separate company, but they run the stock exchange for Australia. That's the biggest stock exchange. There are others, but it's the biggest one. Now, the ASX allows you to own shares or ETFs. So like the ACDC ETF that Blair was talking about, or BHP shares that I was talking about, so on and so forth. So then you buy them. And typically, your name is recorded. You give Selfwealth permission to record your name against those shares at the ASX. So there's like an independent thing here if you've got CHESS sponsorship. So that sounds like gobbledygook. I'll get to that in a second. But this basically means that your name is recorded against the share that you own, which is different to stock exchanges overseas where your money is pooled with everyone else's money. So it's a bit different. Okay. Francis, I'll get to your comment in a second. So what happens is that the ASX registers the shares that you own, but the share, so say BHP in this case, and ETF, say ACDC, the BHP, or in this case, Global X, will select the company that manages all of the admin for the shares and for the units in the ETF. So this company is Computershare, Boardroom, Link, etc. So you don't select this. This automatically happens for you, okay? So keep that in mind. But they'll send you paperwork because you have registered through the system that you own shares or ETFs in this company, and they have to send it to you. So you'll receive what you first think is as random letters that you know nothing about. The way to stop those random letters is to take the information that you have available, your shareholding number, that sort of stuff that's typically found inside your brokerage account, and you go to the website and you register for digital communications. Now, there are other things that you need to do on this website that could save you a lot of money. So you should update your bank details. I got a question last week and I was subsequently corrected. But imagine if you have some money left over at one of these places. So one of these places or one of these places, the money can actually be donated to a charity if you don't claim it. So this also applies to dividends. If you get dividends, you want to make sure that the bank accounts are paid. Are correct, so that you're paid. Now, you can also update your dividend reinvestment plan. So dividend reinvestment plan, or DRP, otherwise known as a distribution reinvestment plan if you invest in ETFs. So in the case of, let's get this out of the way, where was ACDC? Now it should be on this page. So on this page, where are we? I can't find it. Maybe my eyes are, here it is. Registrar. So here we go. Computershare is the one to manage your ETF. So you would log into Computershare using the information for your ACDC shareholding. And that's basically how you would manage all these things. And you can change the communication style from paper-based to email-based or something like that. You can also use the information to vote on what happens inside the company. So it's not so much for ETFs, but for companies, say if you own shares in BHP, you would log in here and vote. If you were given shares by your employer, so say you work for Commonwealth Bank, chances are you don't need a brokerage account to do it. If you only want to sell those shares, you can just tell the registrar or the registry to sell them for you, and they'll do it for you. Okay. So we've got a few comments here. The one that I laughed at before was from Francis that said Computershare is the worst one out there. I'd say they're all pretty bad, to be honest. I've just started with Code Bond, and we'll listen in the next week to see if it suits my investment needs. Financial freedom, you're responding to Lily. Okay, so the reason, Francis, that the share registries are so terrible, just so you know, is if you think about it, they really can't update their systems unless the ASX updates its systems, right? Because this needs to work with this, and this needs to work with this. So, and there's another organization that sits in the middle here called the Clearinghouse, by the way. And this needs to work with this, needs to work with this, needs to work with this. And it all needs to work with the ATO as well. So there are multiple reasons why when you're a software developer, you can't just go like, I'm going to build Selfwealth and I'm going to create a new age one starting today. Because you're governed by all of the existing infrastructure, which, to be honest, is pretty old. So once you know where to look in Link or Computershare, you know where to go. Martin, you said, I found Computershare okay, so long as you don't need to hold them for me. You don't need to talk to them. Okay, I've got a few things here. Penny, you said, it gets a bit confusing when you have shares on different computer registries. I have a stock which delisted from the ASX and now registered with Computershare in the Jersey Islands. Oh my Lord. Penny, sorry to hear that. It does. And you have to maintain both. So and that's a foreign holding net. It's just, that's a lot. So Financial Freedom with Boardroom, instead of accepting the electronic comms only, they have been mailing hard copy confirmation of transactions, hopefully for not too much longer. What a waste of money. Yeah, well, that's been going on for years, Financial Freedom, just to try and get the ASX to stop like these registries sending millions of copies of paper a year, I'm sure, has been an absolute nightmare, but I think they've finally got there. Yeah, so Paul, do they charge a fee for selling for you? Yes, they do. Chef Circle said, very strange that ASX doesn't allow after-hour shares. Yeah. Who knows why? Maybe it's, I don't know. Okay, so the final thing that we have done on this page, so I just want to confirm one final thing. Please go to the share registry and update your bank details when you buy an ETF or share. You can create an account there. And just remember, though, that you will probably have to use all of them because you don't have a choice over what your company or ETF provider chooses. But the two biggest ones by far are Computershare and Link. And by the way, both of those are on the actual stock market. So you can invest in them. Sometimes the worst businesses in the world are often good investments. So here's Computershare, up 1,000% all time, not including dividends. Link's not quite as pretty. It hasn't been listed for as long. Down a bit, but they also sold PEXA, which is the property exchange business. Matthew asks, any reason why my Woodside shares didn't get reinvested? Matthew, sometimes you can select dividend reinvestment plan. I don't know the exact situation, but sometimes the company can pause it, right? So sometimes the company can pause it. So maybe just have a look at that. I don't know exactly why. It could be any number of reasons, but maybe just have a look at that. Okay, so the final thing that I wanted to call out tonight is how do you manage your tax? So you've got your ETF portfolio set up. You feel like you're fabulous for having given it a crack. So what actually happens with tax? Now, if you register your tax file number up in here with your share registry, that should, in theory, pass your information across to the ATO. But you want to double check everything. When you own an ETF, it's different to when you own a share. When you own an ETF, you will receive some type of statement like this. And you can see how it kind of sets out on the screen. This number here, depending on whether it's an X or not, will tell you whether you've got a CHESS-sponsored shareholding or not. That's where you've got your individual name tied against one particular share, or whether you're just in the other version. You can see here the name of the ETF. You can see the tax year. These tax codes can be used by you when you do e-tax, or when you use the MyGov portal, or when you give it to your accountant. You can see the different types of income. So in this instance, that's just an example of the cash ETF from BetaShares, AAA, and you can see that there's really none of that sort of stuff. But what you would expect to see if this was, say, Vanguard VHY, which is the dividend ETF, or even VAS, which is the big Australian shares ETF, you would expect to see some franking credits, and you would expect to see some capital gains and so on and so forth in here. Now, you have to receive this in Australia because, remember, ETFs are trusts. They're not companies. So underneath the surface, there's a trust that you're buying into. You're not buying a share. That's why they call it a distribution and not a dividend, because you're getting a distribution of income or capital gains from the ETF, whereas you get a dividend from a company. So that's kind of the differences here. But you can see all of this information. You can just take this and give it straight to your accountant, or if you do it yourself, use the codes. And that's basically how it works. You don't receive this straight away. This takes a few months. And this is yet another reason why we always say to keep your investing as simple as possible. Because the last thing you want is to have 30 different ETFs and to receive an ETF statement from every ETF provider. Just try and keep it simple. Update your information. Try and set a reminder. This is a tip here from Kate, my co-host on the podcast. Update your details in your share registry every month. Just do it. Set a calendar reminder in your Gmail or your Hotmail or whatever you use, and just say, set a calendar reminder every 6 months. Go to the cafe, fill out your tax paperwork and your share paperwork. And that's basically it. Here's my quote for this evening. If you have any questions for how we will build an ETF portfolio, like Lily asked, which is a great question. Oops, if I can go back to 100%, there we go. I will be answering all of your questions next week. Here's the quote from Morgan Housel. Use money to gain control over your time, because not having control of your time is such a powerful and universal drag on happiness. I think it's a really good quote. And if someone like Dave Gow from Strong Money Australia, a fire advocate, could hear me say that, he'd probably be proud. And I'd say that's a great way to live. Morgan had the other saying of financial freedom to him is doing, and it's my favorite definition of financial freedom, which is doing what you want, when you want, with who you want. So that's probably the best definition of my best definition of financial freedom. But hey, speaking of that, actually, we do have some guests lined up for May. So not on the topic of ETFs specifically, but we do have some great guests. And I can tell you, I have made contact with the one and only Queenie after you mentioned her last week. I messaged her and said, "Hey, Queenie, would you want to come on the show?" And she said yes. So that's great. And we've got some really good investors lined up as well for May. And then at the end of May, we're actually starting another mini series with expert guests from around Australia. So, and that one will be on value investing. So how do you actually pick individual companies? It will be with some of the best value investors in the country. So that's going to be great. So next week, remember, 6 p.m., Rob and I are going to be here, and we're going to be probably finishing off, unless we can sneak in one more guest, we'll see. We're going to be finishing off our ETF mini-series, in which me and you, we're going to build an ETF portfolio from scratch. And I'm thinking it might even have different case studies of people and how they might think about the different options that are available for their circumstances. And it's obviously general advice in nature, but it's an opportunity to kind of put all of the ideas around risk profiles, objectives, how to manage a portfolio, how to, dollar cost average, avoid temptation, all that sort of stuff, and put it into practice. And this is what I see in our community over at Rask a lot. So that's what I'll be combining. So I can see financial freedom seems to be very happy about Queenie, I'm guessing, which makes sense. One final thing before we let you go. Rob will like me for saying this. If you haven't already voted in the Max Awards for Selfwealth Live, so that's this thing, I'll get it up. I'll put a link in the show notes in the chat as well. Max Awards 2023. If you haven't already voted in this thing, do you want to do us a favor and vote for us? It takes 30 seconds to vote for us, and just select in number 10. Would you mind? Just select Selfwealth Live. That's it. That's all you got to do. Select submit. And I can see Rob's in the chat. Please do that. It makes us very happy. For Rob and I, as people that want to create educational content and share it with the world, whether it's through Rob's and Alex's version of the podcast, which is Big Swinging Stocks, or whether it's Rask over here, we just want to help. So give us a shout out on the old Max Awards, and we would really appreciate it. Thanks, dudes. Champion, says Benny. Thanks, Benny. Love your work, mate. Okay, so thank you so much. We'll be back next week. And next week promises to be the biggest, I think will be the biggest episode of them all, because we'll bring together all of the insights from everyone, and I'll answer all of your questions next week. So thank you for joining us. Remember that sometimes, it's the night's darkest before the dawn. And if you think about investing, I think the money is made when you're uncomfortable. And if that's the way we think about the economy right now, maybe things will start to look up sooner rather than later. I'm hopeful, natural optimist, but we'll see. Thank you, everyone, and we'll see you next week. Same time.